Welcome back, accounting students. We are here to discuss the chapters for Module 3. Those would be chapters 5 and 6. For Chapter 5, I'd actually like to show you an observation, an amazing coincidence. No, not really. It's literally something that it's an insight that might make Chapter 5 and its emphasis on the closing process much more intuitively obvious for you. And so to do that, let's open Chapter 5 and go to Figure 5.4. Now this is the adjusted trial balance before closing entries, pre-closing. And as you can see, we begin this figure by listing the assets, everything from cash through equipment and the decline in the value of the equipment because we've been using it, which is the accumulated depreciation. Now, for the most part, these being assets, the asset balances are all debits, except if equipment is an asset with a debit balance, then the decline in the value of equipment would be the opposite of equipment, and therefore that would have a credit balance. Then we have our liabilities, which by and large are credit balances. Here we have three: accounts payable, salaries payable, and unearned revenue payable. Please keep in mind that the whole idea behind unearned revenue being a liability involves the fact that if someone pays you money, and if you have not done any work to earn it yet, you might have to pay it back if you don't actually do the work. That's why it's a liability. And then finally, we have the equity value or worth numbers. These in the very first Chapter 2 table that we discussed were either placed in common stock or retained earnings. But since Chapter 2, we've given more descriptive detail to these changes in earnings. And therefore we have different types of revenues and different types of expenses, where revenues represent increase in value and expenses represent decreases in value. What I'd like to point out, though, is that the asset balances, the liability balances, and the very first value balance, that is common stock, those are the first 5 debit rows and the next 5 credit rows. Put another way, first 5 rows, all debits, 24,800 through 3,500. Next 5 rows, all credits, accumulated depreciation equipment, $75 through common stock, $20,000. Why do I find this so noteworthy? Well, this is Figure 5.4. Let's look ahead to Figure 5.8. What's important about Figure 5.8? Well, if you look at the title, this is the post-closing trial balance. So all of the closing entries in Chapter 5 have been made, and you have to admit there are an awful lot of them. Take a look at those first 10 lines, though. The first 5 lines are cash, $24,800, through equipment, $3,500. Well, wait a minute. Those are the same numbers that were the first 5 rows of the pre-closing trial balance. Look at rows 6 through 10. They are credits, ranging from $75 to $20,000. Once again, these are the same 5 numbers in the same 5 accounts that appear in the pre-closing trial balance, figure 5.4. Well, figure 5.8, the post-closing trial balance, only has 11 lines. The first 10 lines are the same as in the pre-closing trial balance. It's only the 11th and final line, the retained earnings line, that differs. What is fundamentally happening as we move through all of the journal entries in this chapter, the closing process, is the following. For the most part, there aren't really any changes to assets, to liabilities, or to the common stock column in value. What's really happening is that pre-closing, instead of a single account called retained earnings, we have many, many, many different accounts. And through the closing process, we consolidate them. We make a few changes along the way, of course, and we end up calling all of those different balances retained earnings. Bottom line, going from the pre-closing balance, figure 5.4, to the post-closing balance, 5.8, asset, liability, and common stock value, those accounts all stay the same. The other accounts are indeed consolidated into retained earnings, a single line item on the post-closing trial balance. And that concludes my commentary about Chapter 5. I do have an additional comment or insight to share with you about Chapter 6. And to illustrate that insight, let's go to, it's the one that is titled Recording a Retailer's Sales Transactions. And it seems to have 3 transactions, one occurring on January 5th, one occurring on January 9th, and one occurring on January 14th. Now, please keep in mind, this involves a retailer. It's a store, basically. And the retailer, like any other store, is operating as follows. It purchases inventory, it puts the inventory on a shelf, and when a customer comes by to purchase the inventory, it sells the merchandise, the asset, to the customer. There's one very, very, very important point to keep in mind. When the customer buys the inventory, the merchandise, as in this case the customer does on January 5th, there are actually 2 different transactions that occur. Now you might say, wait a minute, customer comes in, buys a product off my shelf. Isn't that one transaction? Technically, no. It's 2 transactions. Number 1, the customer says, I owe you money, and either pays you money on the spot That would be an increase in cash for you. Or promises to pay you later. That would be an increase in the asset receivable. But there is a second thing that occurs, and it's easy to forget about this. Not only does that customer pay you or promise to pay you, but the customer walks away carrying the inventory. They bought something from you. It was merchandise sitting on your shelf. It was your asset, but when they take it away, it's no longer your asset. So what's happening here is, on January 5th, you bought a piece of equipment for resale. You originally paid the manufacturer $1,000 for it, but you sold it to a customer for $2,450. That's a pretty good markup. Buy something for $1,000, sell it for $2,450. Nice. Two different things happen. The customer promises to pay you $2,450 at a later date. The asset accounts receivable increases by $2,450. Your value increases by $2,450, and we call that increase sales revenue. But what also happens on January 5th is the customer walks away with the $1,000 piece of equipment that they bought from you. And so your inventory declines in value by $1,000. Well, if an asset called inventory declines, value declines. That would be an expense. And we call that decline cost of goods sold expense. That's what happens on January 5th. And it's still very important. It's always important to keep in mind. In merchandising transactions, when a customer buys your inventory, which at the moment they buy it is still your asset, two things occur. They walk away with the product. That would be a decline in value, but they also promise to pay you for it, unless they pay you in cash for it, and that's an increase in value. The first decrease in value is an expense, cost of goods sold. The second increase in value is revenue, sales revenue. And those are my two sets of insights, one for Chapter 5, one for Chapter 6.